Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Vertiv Holdings Co, ticker VRT. This is a stock that has, well, it's fundamentally reshaped its narrative over the last 2 years, and it's been driven pretty much entirely by its positioning as an essential supplier of AI infrastructure. So if you are trying to separate the operational facts from, the valuation fiction, you've landed in the right place. Vertiv positions itself at the heart of what it calls a perfect alignment of opportunity, and that's the convergence of digitization, the global energy transition, and most powerfully, the AI revolution.
That alignment is absolutely central to the thesis, but so is the inherent risk priced into the company today. To put it simply, Vertiv's an essential AI infrastructure provider betting its record $9.5 billion backlog, and NVIDIA co-designed 800 VDC technology will successfully execute a multi-year build-out, driving 27% annual organic growth and justifying an extreme 44x forward PE valuation against AI concentration risk and geographic softness.
That thesis statement right there, it sets up one of the most intriguing conflicts in the infrastructure market right now. We're looking at a company that is, undeniably critical to enabling the digital age. You literally can't run an AI cluster without them. And yet, the market has applied a premium that just screams, like you said, flawless execution required. Our mission today is to give you a comprehensive, actionable understanding of VRT's current position. We'll examine why they are succeeding, detail the strategic plans they have to sustain that success, and crucially, dissect where the structural risks lie beneath that sky-high valuation. So let's go straight into the heart of their performance metrics. Let's start with the hard numbers, because Vertiv's third quarter of 2025 results were, well, by the company's own measure, extraordinary. The executive chairman, Dave Cote, noted they exceeded guidance across all metrics in a very convincing way. And this isn't just some minor beat. This demonstrates fundamental financial strength at a moment of really rapid scaling.
The raw financial indicators, they show a staggering momentum that has completely changed the perception of this business. So consolidated net sales hit $2.676 billion.
And to put that momentum into context,
Right, that was up 29% year over year. And crucially, 28% of that growth was organic. So it wasn't driven by M&A or, currency fluctuations. Profitability was even more pronounced. Adjusted diluted EPS came in at $1.24.
that's a
A
massive.
massive 63% year-over-year increase. And it surpassed the average analyst prediction by a very comfortable 25-cent margin.
And beyond just the top and bottom lines, the quality, the execution, you can really see it in the margin expansion. They managed to expand adjusted operating margins by 220 basis points, climbing to 22.3% in Q3. In a period of rapid capacity expansion and, supply chain pressure, that margin growth suggests they're efficiently handling the rapid scaling required by their hyperscaler clients. That operational leverage is absolutely key to achieving their long-term margin goals.
It is. But the most powerful signal the market is receiving right now, and really the primary driver of confidence, is the sheer size and quality of the backlog. Vertiv reported a record $9.5 billion backlog,
$9.5 billion.
and that represents a substantial 30% year-over-year increase. What drives this? They saw a remarkable 60% year-over-year order growth in Q3 2025, which, translates into a highly aggressive 1.4x book-to-bill ratio.
Okay, let's unpack this for a moment, because a backlog of that size, especially during an inflationary period, can sometimes be misleading. Couldn't that just represent elongated lead times? The queue is longer, but the output rate hasn't necessarily increased. How do we verify the quality of that $9.5 billion?
And that's the critical financial distinction. You have to address the risk of speculative double ordering, something we saw in certain semiconductor cycles previously.
Yeah.
Management was very specific in clarifying this. They stated the backlog phasing is within typical levels for Vertiv, meaning the orders are mostly scheduled to ship within 12 to 18 months.
Okay, that's crucial.
It is. It suggests the growth isn't due to customers placing orders years in advance just to hold a place in line. Instead, the backlog growth is driven by actual customer project deployment phases maturing. They are moving from planning to purchase orders tied to specific, committed phases of their multi-year AI factory projects. It indicates deployment readiness and firm commitments, not mere speculation.
That distinction, firm commitment versus speculative ordering, that's why the market sees this as such robust visibility into 2026 and beyond. This isn't just a promise, it's a detailed shipping schedule. And looking at where that immediate cash flow is coming from, the Americas segment is the core growth engine right now. It expanded its revenue by a stunning 43% in Q3. This concentration is a theme we will definitely revisit when we discuss risk, but for now, it is the primary driver of momentum.
And this exceptional momentum led management to significantly raise its 2025 guidance. They're now projecting $10.2 billion in net sales and $4.10 in adjusted diluted EPS for the full year. And this is what sets the bar for their valuation. To hit those numbers, it implies achieving 27% organic growth for the entire year. That 27% growth target, sustained over the next few years, is really the only way to validate the generous premium the market is currently applying to the stock.
All right, so now we get to the core of the business, the technological moat. And we talk about these massive AI factories built to house chips like the NVIDIA GB200. Vertiv is positioned as the essential, non-negotiable hardware supplier. What exactly are they supplying, and why has this become a mission-critical function rather than just a commodity product?
Vertiv manages the two absolutely critical complex flows in an AI factory: power and cooling. On the power side, they provide everything from the large-scale uninterruptible power supplies, or UPS, and customized distribution systems, right down to the switchgear that handles the massive load. On the cooling side, it's the thermal management systems, heat rejection units, and the complex mechanics of liquid cooling distribution units, or CDUs. The fundamental reason this is foundational is the change in data center philosophy. They are evolving from linear, low-density server farms to incredibly dense supercomputers, pushing power densities to extreme levels, often between 100 and 600 kilowatts per rack.
That density is the game changer. If you are packing that much heat and power into such a small space, thermal management isn't optional. It transitions from an operational concern to a mission-critical imperative. If the chips aren't cooled efficiently and instantly, the system, the thermal, trips, and that results in downtime and massive financial losses. That's the core vulnerability Vertiv is designed to mitigate.
Precisely. And that necessity leads directly to their secondary moat: services and integration. It's one thing to sell the hardware. It's another thing entirely to guarantee the uptime of a customized high-density AI system over its decade-long life cycle. Vertiv addresses this through its Global Service Organization, which is a massive operational asset. It boasts over 4,000 field service engineers.
4,000 engineers. That's not cheap, but it sounds essential. What specific role do these teams play, especially in this era of liquid cooling, that makes them irreplaceable?
Well, their role goes far beyond simple repairs. These teams handle the complex installation and commissioning of new systems, especially liquid cooling, where ensuring the absolute cleanliness and integrity of the fluid loops is paramount. Any contamination can reduce thermal efficiency and risk damaging the multi-million-dollar GPUs. They also provide ongoing lifecycle support and predictive maintenance, making Vertiv an embedded, trusted partner rather than just a product seller. This structure creates that long-tail, high-margin, recurring revenue opportunity that the market just loves.
And that embedding, that's reinforced by their systems-level integration approach, right? They emphasize owning the entire solution stack.
Correct. They own the entire thermal chain, the powertrain, and the entire white space portfolio. This allows them to provide seamless integration and optimization, which is key when hyperscalers are building these customized, multi-megawatt AI factories that must scale rapidly. And internally, this efficiency is driven by the Vertiv operating system, or VOS.
Right, the VOS. The critique we saw noted that just calling it lean methodologies was, well, superficial. If VOS is the internal engine driving their big margin expansion goal, that 25% adjusted operating margin by 2029, we need to know how it creates a tangible advantage over competitors.
Okay, so VOS is essentially an integrated corporate discipline. It's focused on maximizing velocity and eliminating waste across the entire value chain. It's not just a buzzword. For example, it drives strict procurement standardization, which allows them to dual-source common components globally while maintaining quality. It pushes lean methodologies into the design process, accelerating the shift toward prefabricated modular solutions. By applying VOS principles to their supply chain, their local +1 multi-region strategy, they ensure resiliency and can pivot capacity quickly. This systematic approach gives them measurable labor efficiency and material cost advantages, which is precisely how they sustain long-term incremental margins in that 30% to 35% range, even as they scale so rapidly.
That makes VOS sound less like a PowerPoint slide and more like a key structural competitive advantage in logistics and production. But in the AI world, you have to be ahead of the curve technologically. And here's where it gets really interesting: the relationship with NVIDIA.
Their status as a solution advisor in the NVIDIA partner network is the ultimate signal of their technical relevance. This means they literally sit at the design table with NVIDIA's engineers. This partnership enables them to co-design critical power and cooling reference architectures, such as, the specifications required to reliably support the forthcoming NVIDIA GB200 and VL72 design.
Why is that co-design so crucial in this specific market?
It's because the physical infrastructure, the power and cooling it, operates on a much slower planning and construction cycle than the silicon development cycle. Vertiv has to anticipate the massive power and cooling needs of the next generation of chips before they even hit the market. If they aren't ready, the new GPUs, like the anticipated 2027 rollout of the NVIDIA Rubin Ultra platforms, simply cannot be deployed. This level of collaboration is non-negotiable. It guarantees their place in the future ecosystem.
Let's discuss the specific technological shifts they are mastering. Let's start with the power side. We are moving beyond the traditional AC distribution architecture for these huge, dense racks.
That is the pivotal shift toward 800 VDC power architectures, so higher voltage direct current distribution. Traditional AC power, it suffers from efficiency losses and complexity when managing the extreme megawatt-scale power requirements of next-gen AI racks. 800 VDC simplifies the architecture, improves efficiency, and is inherently better suited for massive DC loads like GPUs.
Our sources highlighted Vertiv's decades-long experience in DC power infrastructure from the telecom space. How does that legacy knowledge translate uniquely into a modern AI competitive moat?
It's their institutional knowledge of reliability and scale. Telecom networks, especially wireless infrastructure, have always relied on highly reliable distributed DC power systems to ensure continuous operation. Vertiv essentially perfected that system decades ago. Now they're scaling that expertise up from small telecom sites to large-scale data centers. They know how to design, build, and service 800 VDC systems that have to operate flawlessly 24/7. They've publicly committed to having this 800 VDC powertrain technology ready by the beginning of the second half of 2026.
And that timeline is explicitly synchronized to precede the commercial deployment of those future NVIDIA chips.
Exactly. That prior experience drastically cuts down their R&D and time to market risk.
Okay, on the cooling side, the shift is even more dramatic. Liquid cooling went from an experimental niche to, well, mandatory infrastructure almost overnight.
The scale of their investment reflects this necessity. Vertiv expanded its liquid cooling capacity by 45x in 2024 alone.
45 times.
Yes. And they haven't just bolted on production lines. They've used strategic acquisitions to ensure they own the full thermal chain solution. They brought in CoolTerra Ltd. in December 2023 for advanced liquid cooling infrastructure solutions, and they acquired BSE to expand their portfolio with essential chillers, heat pumps, and sophisticated air handling units. They are building a self-contained ecosystem to deliver these complex cooling solutions.
In the AI race, speed to deployment is currency. How is Vertiv helping customers get these complex systems online faster? They are using prefabricated modular solutions, aren't they?
Absolutely. Traditional data center construction is slow, complex, and it requires high-risk on-site labor integration. Vertiv has solved this problem with prefabricated modular solutions like Vertiv One Core and Vertiv Power Nexus. These are integrated, tested modules shipped to the site ready for quick assembly. The quantifiable benefit here is huge. These modular solutions reduce the customer's time to first token by up to 50% compared to traditional construction.
Time to first token. That's a great phrase. For the hyperscaler, what exactly is the economic value of reducing that time by half?
Well, the token is the first unit of AI work produced. For a major customer, every day a multi-megawatt AI cluster sits idle, they are losing millions in potential revenue, whether through internal usage or external cloud service sales. Reducing the deployment time by 50% means the customer starts generating revenue, or tokens, months earlier. It's a massive improvement in return on capital employed, or ROCE, for the customer. It makes Vertiv's solution not just a product, but a critical enabler of their client's time-to-revenue model.
And this isn't just a marketing concept. They are backing this with tangible manufacturing capacity, like the new dedicated facility in Pelzer, South Carolina, focused specifically on these integrated modular solutions, which also further reduces high-cost on-site labor requirements and ensures supply chain resiliency right where the demand is highest in North America.
Okay, moving beyond product design, let's look at the macro environment. Vertiv is strategically sizing the opportunity they are capitalizing on. What kind of revenue are they capturing per project, and what's the long-term forecast for the industry they serve?
Management provides a very detailed breakdown of their opportunity size. They cite a $2.75 million to $3.5 million revenue opportunity per megawatt deployed in the data center space. And what's interesting is that this number is trending toward the upper end of that range. That's due to the increased complexity and technological requirements of AI systems. So more 800 VDC, more liquid cooling, and more sophisticated integration.
And that ties right into the broader market outlook. How big is this runway? Well, the overall data center market is projected to grow at a robust 10 to 13% compound annual growth rate, or CAGR, over the next 5 years.
That's solid.
It is, but when you look specifically at the segments Vertiv is focused on, the cloud and colocation segment, which is where the hyperscalers and AI buildouts live, the growth is even more aggressive. That segment is projected to surge at a 15 to 17% CAGR. Vertiv is actively gaining market share in these fastest-growing areas, positioning them perfectly to capture exponential demand.
Given the strong cash generation and relatively low leverage, Vertiv has articulated a very active M&A strategy to accelerate their growth into these areas. How much capital are they budgeting for these plays, and what are the strategic focuses?
They estimate having over $12 billion in capital to deploy over the next 5 years, which is an astonishing amount for a company of their size. It underscores their confidence in future cash flows. The M&A strategy targets organic investment, technology bolt-ons to augment the portfolio, and capacity or market share growth provided the valuation is rational. They stress they are not afraid to use acquisitions simply to add capacity if it means locking in future supply for key customers.
We saw two significant examples of this M&A strategy in the second half of 2025 that perfectly illustrate their focus. First, the $1.00 billion cash acquisition of PurgeRite Intermediate in November. This was a very expensive deal for a service company. What specialized function does PurgeRite fulfill that justifies that price tag?
This acquisition highlights the shift from hardware sales to recurring high-margin services tied to system resiliency. PurgeRite specializes in fluid management services, so specifically mechanical flushing, chemical cleaning, purging, and filtration. As liquid cooling becomes essential, the cleanliness and chemical integrity of the coolant loops are critical. If the fluid is dirty or chemically imbalanced, it dramatically reduces thermal efficiency, risks corrosion, and ultimately threatens system uptime.
So PurgeRite steps in at commissioning and then throughout the life cycle to ensure optimal thermal efficiency. This sounds like an annuity business built on critical maintenance.
It is exactly that. PurgeRite services ensure optimal flow of commissioning and preserve that balance throughout the system's lifecycle. You cannot skip this maintenance step in a high-density environment. It turns a large capital expenditure item, the cooling system, into a recurring service need. And importantly, this $1.0 billion deal is expected to be margin accretive to the services segment, reinforcing one of Vertiv's primary high-margin superpowers and diversifying its revenue from purely CapEx spending.
And the second key acquisition, that one bolstered their presence right inside the data hall, addressing the shift in power and cooling requirements down to the rack level.
That was the acquisition of Great Lakes Data Racks and Cabinets for approximately $200 million in August 2025. This deal strengthens their integrated infrastructure solutions, particularly for what they call the critical white space market.
Let's define that critical white space market. For a learner, does this just mean they bought a cabinet maker, or is the AI rack now fundamentally different?
The AI rack is fundamentally different. It's no longer just a metal box holding servers. The high-density nature of AI means power distribution, thermal monitoring, and liquid cooling manifold integration are shifting right down to the individual server rack. So Vertiv is integrating these specialized racks with their UPS and cooling distribution units to provide a single, highly sophisticated, integrated piece of infrastructure. The Great Lakes acquisition gives them deeper control and capacity in this space, ensuring seamless delivery of these pre-integrated AI-ready racks to their hyperscale customers.
All these strategic investments, the VOS operational efficiency, the technology pivots, the accretive acquisitions, they all point toward one key financial target that Vertiv is laser-focused on: long-term margin expansion. What is their ultimate stated goal, and how do they plan to get there?
The stated, and I'll say aggressive, goal is an adjusted operating margin target of 25% by 2029. That is a significant leap from current levels, requiring sustained execution. They plan to achieve this by maintaining long-term incremental margins in the highly efficient 30% to 35% range. This impressive margin profile relies on the compounding operational leverage provided by the Vertiv operating system, the VOS, and their commercial execution excellence, which is really their ability to successfully price their unique essential value proposition to customers who desperately need guaranteed uptime.
Okay. We have spent a significant amount of time painting an extremely bullish, detailed picture. We've got the record backlog quality, technological leadership co-designed with NVIDIA, accelerating growth, strategic M&A, and a clear path to margin expansion. But as a financial investigation, we have to address the elephant in the room that you raised right at the top, the valuation.
And this is where the structural conflict in the investment thesis lies. The stock trades at an extreme premium that prices in years of this expected perfection. Analysts cite a forward non-GAAP price-to-earnings, or PE, valuation of 44x, with some estimates running even higher. This is dramatically higher than its 5-year historical mean of 26.50x.
44 times forward earnings. That demands a critical examination. The core question for you, the investor, is this. Is this premium justified solely by the company's ability to execute on the $9.5 billion backlog and sustain sector-leading growth, that projected 27% annual earnings growth? Or, given the historical context and reliance on market exuberance, does the valuation risk mean the stock is a potential bull trap?
The latter argument gains traction when we look at the structural risks. The first and most significant is AI concentration risk. The bulk of the current, explosive growth that fueled those Q3 results is geographically and client-wise concentrated. We noted the Americas segment grew 43%. That is primarily driven by a handful of North American hyperscalers and cloud builders. While Vertiv sees pipelines strengthening globally, the market needs that growth to broaden substantially to Asia and Europe to fully justify this current valuation. If a few large customers slow their CapEx, the short-term impact on VRT is magnified.
And that concentration risk ties directly into the second major risk, geographic softness, particularly the current headwind in the EMEA segment, that's Europe, Middle East, and Africa.
Right. EMEA showed a noticeable headwind in Q3 2025, reporting a 4% organic sales decline. This is a tangible drag on the overall growth story. Management is confident this region is merely lagging the U.S. and AI build-out and is taking active steps, executing regional restructuring programs, reflected in increased corporate restructuring costs to optimize for the future.
But the anticipated rebound is still a long way out, using what management calls the coil spring analogy.
Yes. The coil spring analogy suggests that data sovereignty requirements, which mandate the data be processed and stored locally, are building tension that must eventually release into capacity build-out. They express confidence that the region will rebound significantly by the second half of 2026. However, H2 2026 is still a significant near-term delay. If the Americas segment falters before the EMEA coil spring releases, that 27% growth target becomes severely challenged, which directly hits that 44x valuation.
And finally, for any actionable financial investigation, we cannot ignore the unresolved legal and compliance risks that introduce unforeseen uncertainty, regardless of the operational success we've documented.
This is a critical factor for due diligence that often gets overshadowed by the AI narrative. In November 2023, the company received an unresolved SEC subpoena and a parallel request for documents from the U.S. Attorney's Office for the Southern District of New York. Both inquiries relate to previously filed securities class actions concerning historical accounting practices.
What are the key unknowns relating to this open legal issue?
Well, the core issue is the potential for unforeseen costs and liabilities. While Vertiv is actively responding to these matters and has publicly committed to cooperating, the outcome remains unpredictable. The SEC and DOJ inquiries, they relate to complex securities claims regarding past restatements of financial results. Even if Vertiv is ultimately exonerated, the process itself incurs significant legal and compliance costs. And more critically, an adverse finding or settlement could lead to substantial financial penalties or forced compliance changes, adding a non-operational layer of uncertainty to the investment profile that has to be accounted for in the risk assessment.
So let's synthesize the investment case. On one side, we have an unparalleled story of growth visibility, backed by a near $10 billion backlog of firm customer orders, coupled with critical technological leadership and high-density power. That's the 800 VDC and cooling, the liquid cooling expansion. They have the operational engine, VOS, and the strategic M&A, like PurgeRite, to justify a path to a 25% margin.
That's the bull case. But that bullish foundation supports a 44x forward PE, an extreme premium that mandates sustained 27% growth. That target complicated by exposure to AI concentration risk with North American hyperscalers, the short-term headwind of a 4% organic sales decline in EMEA, and the open-ended legal and compliance liabilities stemming from the SEC and DOJ investigations.
So the final thought is this. Considering Vertiv's strategic capacity expansion, like the new modular solutions facility in South Carolina, and its explicit co-design work with NVIDIA, how quickly must AI data center demand accelerate globally? I mean, truly expanding beyond the current North American hyperscalers and triggering that coil spring release in regions like EMEA to validate a valuation that has already priced in several years of perfect 27% execution.
Risk defined, portfolio protected.